The US and China have come to an agreement at the G20 in Japan to restart trade talks, providing a boost to global equity markets. But is now the time to look to emerging markets for opportunities? Mike Ingram is an independent market analyst and joins me now to discuss. Mike, good to see you. So the truce seems to be the key word of the day. Do you think that this is enough to provide a meaningful tailwind for those looking to invest in emerging markets at this stage?
Well, the market certainly thinks so at the moment. If you look at how institutional investors at least are positioned, I mean, while they came into the year being full-on bullish on emerging markets, they've largely trimmed down to more or less a neutral position, and that's within the context of a significant de-risking of institutional portfolios overall, significantly flipped from equity into cash and, rotating at the sectoral level into things like staples. So the fact that they've still stuck with emerging market with a market weighting probably tells you that they feel there's an opportunity out there. Now, what seems to have been agreed is them not to go to war, at least at the moment, and that's been enough for where markets are at the moment to, give these markets a little bit of a boost. Take a step back from that, there's a lot of dynamic tension there. It's like stating the obvious, but what I'm thinking of here is it's a race against time between the Fed leading, the monetary reflation, which we've seen started with their January pivot, against the sort of, if you like, the dominoes starting to fall in terms of global activity. So at the moment, we know that global manufacturing has taken a huge hit, and we were reminded of that only earlier on today with, soft Tankan out of Japan, Kaishin PMI looking weak, Eurozone PMIs, UK PMI, looking horrible. Now, we've seen the sort of the services PMIs in all of these countries to a very large extent being much more resilient, and and to some extent that's a proxy for the consumer. Now, if we don't have any resolution, and I mean an improvement on the situation, I'm not talking about a ceasefire which has been agreed between the US and China at the G20, I'm talking about actually moving towards a resolution, then the likelihood is we'll continue to see these dominoes start to fall. So, we're starting to see softening business intentions, for instance, and then the final one to go, which is the real killer, is going to be going into the consumer, where employment prospects are dampened down, real disposable income is reduced, and depending on the economy, that's between 50 and 70% of most economies, and then we're talking about big downgrades to GDP, big downgrades to earnings. The only thing I would say, one last thing, is that it's global trade that made emerging markets rich. It's global trade which stimulated those investment flows and that reconfiguration of supply chains, which is now being significantly disrupted. And so, to some extent, whilst global trade has been to a great benefit of global emerging markets, what is going on right now is potentially extremely harmful.
Does that mean that it's a resolution that we really need in order to continue the gains for emerging markets? Obviously, it was a very strong month for the MSCI emerging markets index, rallying by around 7% since the lows back in May. So in order for momentum to continue, you mentioned the fact that we've had this sort of truce, but that's very different to a resolution. I mean, what's the chances of getting a real deal, and is that what's necessary to provide further upside?
Well, as I said, there are two things. The one is the monetary reflation, the other thing is the trade. I think trade, a lot of people were saying when this all kicked off about 18 months ago, it'll be over pretty quickly. It's, Trump will have a tantrum and it will be, so we're still here. It's still a thing, and obviously it's escalated significantly over that 18-month period. And also, be reminded that a lot of people in the first year of Trump's presidency said, well, he was just saying that, he won't do it at all. He wants to deliver on his promises. Now, ultimately, what might drive the resolution of the trade is again the electoral timetable, because the US is going to be in an election in less than 18 months now. By this time next year, he's going to see, Trump is going to need to see the US economy firing on all cylinders, and preferably accelerating, and stock prices being buoyant and everybody feeling happy with things, and so they can go in November of next year and vote Republican and vote him back into the White House. If that isn't happening at that time, then the chances of him being turfed out by a Democrat are obviously that much higher. Now, you and I can both say, well, that's true. Does he realise that that's true? And does he realise just, where there's a tipping point where, even if he starts to sort of, put policies in place to enable that outcome, that economic outcome, has he left it too late? Because, you start to get to the point where you get to a point of no return. As I say, these are kind of dominoes falling. Now, over the short term, so I'll try and answer your question rather more properly, it's the one who can come to the rescue, it's the Fed. Yeah, and clearly that's pretty aggressive action on the part of the Fed. It's already being priced into rates markets. Now, as I said, to some extent, the market was disappointed by the most recent FOMC, by the most recent dot plot, because they only moved very tentatively in that direction. But, if we, I think, to avoid, absent any political resolution over the short term, and by short term I mean 1 to 3 months, which I don't think is on the cards because China's clearly also hardened its position, the Fed has to step into that gap, I think. And to do that, we have to see certainly at least a 25 basis point rate cut at the end of this month. And I think, significant signalling that, a lot of the rate cuts currently being priced into markets are likely to be delivered by the Fed to put a further floor. That being the case, as I said, that neutral position that, institutional investors seem to be having in emerging markets, that be validated, that tentative widening credit spreads, which we've just about seen in emerging markets, but it's not big. Credit's actually been quite well behaved. The pressure will come off there. The dollar presumably will start to come down. You start to see, a lot of stale bulls in the dollar. CFTC specs spread. They're all coming down. So you could see they're pushing on a half-open door. But I think it needs the Fed to deliver first, and on a longer-term view. And here I'm thinking about 3, 6, certainly 9 months. We need to see Trump also shoring it up for emerging markets.
Well, like you alluded to with the Fed, obviously one of the notable consequences of a dovish shift would be a decline in the currency, and we did see the US dollar pull back quite significantly. I've got the chart here and we can see the declines from the high around the middle of June. It has been clawing back up a little bit. Nonetheless, we are a way away from that high in June and even further away from that high towards the end of May. So, I mean, like you say, there has been this consensus view towards the dollar that we do look broadly bullish for a long time now, coming up to a year and a half. So is this the time that we start to roll over, or do you see the gains continuing? And of course, what does that mean for emerging markets?
I think there's probably further downside at this stage. I mean, I think it is a bit of a in as much as it's driven by rate differentials. Yeah, so let's not forget where we were 18 months ago, where we had an unexpected weakening of the dollar into 2017, and so of course forecasters did what they always do and go, well, that will continue, and interest rate differentials don't mean anything anymore. And of course, that's just the point where the dollar starts to rally, which it did almost continuously through last year.
And the point with differentials, of course, is the fact that it's comparing it to other central banks, and we're seeing this global shift towards more dovishness. So
it's a race to the bottom, effectively. So not all currencies can be weak against each other. Somebody has to be strong against something else. And of course, this is one of the things that Trump is continually railing about. And of course, more recently, Mario Draghi came up for a great deal of flack from President Trump for when he essentially ambushed the ECB at Sintra, which is his retirement present. Thank you very much, Mario. But yeah, I mean, I think one thing I should bring into this is that yes, I think the short-term fix is monetary reflation, led by the Fed. But what's quite interesting, actually, if you look at recent asset manager surveys, one fear which is coming in now, and this is almost a parallel thread to this sort of horrible phrase secular stagnation, which was bandied out a few years ago, it's gone off the burner for a while, might be coming back in again, is this idea of policy impotence. We've got to the stage where we didn't even get to neutral on US rates. They started to pare back that balance sheet, then they backed away. And we keep saying this is a last roll of the dice, and there's always another roll of the dice, you say, but there's this horrible feeling that, okay, central banks can and have come to the rescue to a large extent so far this year. There's no doubt that the Fed's impacted markets. I mean, the idea that monetary policy is impotent at this point in time is still clearly not true. But its ability to actually affect the real economy, and over the longer term, does it stall a problem of the future? That is a major issue.
So in terms of the opportunities within emerging markets, we heard from Morgan Stanley last week that now is the time to buy emerging market currencies. Do you echo that view? Do you think that's a good trade right now, looking to the currency space? And if so, which currencies are drawing your attention?
Yeah. Well, I mean, emerging market currencies overall are very, very cheap. I mean, there was only a small rally from, I think, October last year. from an all-time low in terms of the emerging market currency index, which people such as JP Morgan and so forth put together. You have seen a little bit of softening over the last quarter, and again, this seems to be sort of largely based on the news on US-China trade, which we had until the G20 this last weekend. So yeah, I mean, I think there are a whole host of emerging market currencies which are looking cheap. If you wanted to be really high octane about it, you'd have to say, well, hang on, which of the currencies which have been most beaten up? Let's pick those up. The problem is if you end up with things like the Turkish lira, for instance, and that's where I think to some extent your analysis might start to fail, because, for instance, they've got a big current account deficit. Yes, it's 5.5%. Maybe 6% GDP, and you would have thought in an environment where the Fed is easing rates, that'll help to bring capital flows along. But the problem there, for instance, is you've got problems with politically, with President Erdogan, quite frankly, and obviously this election in Istanbul, which didn't go the way he was expecting, second time round. You've got the central bank, which has, I think, lost all credibility at this stage. So, again, you can look at it from, where's it come from, where is it now, let's do that. And then you start to bring in other sort of, different economic issues, such as, what are the current account positions, how solid are the institutions looking? And then you're going, well, actually, I can see the power of these people to sort of move markets, geopolitics to move markets. Do I really want to go from the frying pan into the fire? I mean, look, there's no doubt, for instance, that the reconfiguration of trade flows, for instance, has benefited some within the Southeast Asia region. So, one which I think you guys were talking about, which is probably the principal example is something like Vietnam. They've clearly been a net beneficiary. To some extent, Thailand might also be a beneficiary. If you believe that we will actually see overall, when the dust has settled, a shift away from many of these supply chains towards something rather more North America centric, then maybe you should, maybe Mexican peso is something to actually look at, particularly if ultimately the US economy manages to regain momentum into next year. So there are lots of different pockets, but I would say that the overall, the currency markets definitely look cheap. I would say that credit at this moment, if you don't have this resolution, then then you may see a bit of a fallout. And equities, well, there I would probably be a little bit more circumspect, because certainly I think that you've got. See, the thing is, when you're buying equity markets, you aren't necessarily buying the economy. It's not true in the UK. It's certainly not true in China, for instance. And a big slug of China is things like Tencent. So you're buying IT as much as you're buying the Chinese economy. But I think if you're looking at a reweighting, which are the markets that they're going to go into first? They're going to go into the big liquid markets. They're going to go into China. They're going to go into India. They're going to go into Brazil. They're going to go into Mexico, and the like.
Mike, thank you so much for your time.
A pleasure.
That was Mike Ingram, independent market analyst, joining us to discuss the outlook for emerging markets. I'm Victoria Scholar, and thanks so much for watching IGTV.